Welcome to Invest Week, a digital series brought to you by the Australian Investment Council. What is private capital? It's an alternate form of investing to public markets. Private capital makes long-term investments into businesses with the goal of increasing their value over time. Private capital investment contributes $43 billion to the Australian economy and creates 1 in 9 new Australian jobs. And it is proven to generate strong returns for investors. So how do you tap into this industry as an investor? This 4-part digital series will take you through what the private capital industry is all about, how it works, how it performs, and some tips on where you might start if you'd like to invest. We will be playing 1 episode per day, and you can access more information from aic.co/investweek. In part 1 of the series, Yasser El-Ansary talks to Mark Richardson from Wolseley Private Equity about what private capital is, how big the market is here in Australia, and its unique characteristics which differ it from other investment strategies, such as the listed equities market. For an investor new to the private capital industry, you will learn about all the general terms associated with private capital investment, what the processes look like, timeframes involved, and what happens after you invest in a business. Mark and Yasser will also discuss the types of businesses that make good candidates for private capital investment.
So thanks for joining me, Mark. We're talking today about private capital. We're talking about what private capital actually is, what private capital investment is all about, what are the fundamentals of private capital investing, and the different strategies that sit within private capital. Before we get into some of those things though, can I ask you to share with me your thoughts on what private capital means to you, how broad private capital is from a market standpoint?
Yasser, it's great to be here. It's always nice to chat to you, particularly about the broadening and more important definition of private capital. I think that's a really, really good way of starting. From my perspective, it's 6 different asset classes. Private equity, which is where I spent my time. Private debt, venture capital, real estate, infrastructure, and I'm very pleased to be able to say also agricultural assets. So it's very broad and diverse and quite a complex investment structure.
What about the size of private capital here in Australia? A lot's been said over the years about this part of the market. We hear lots of stories about really innovative companies, Canva, Atlassian, a whole range of great Australian success stories. All of those sit underneath this broad umbrella of private capital. How big is that umbrella? How big is private capital in Australia?
Well, it's actually quite surprising that in total it's about $68 billion today, of which roughly half is in the traditional private equity and venture capital space, and roughly half is in the other 4 asset classes that we just talked about. And that's been growing pretty consistently. And it's it's good to see that it's got that kind of scale that you represent. You do a good job of it too.
That's right. Look, for me, I think private capital has been on such a significant journey over the past decade in particular of growth and expansion in the sheer size and scale of what this industry represents. And to your point a moment ago, the 6 different sub-strategies, if you like, that sit underneath that broad umbrella, all have their own trajectories in terms of where they've come from and where they're going. Which is really astounding because I think here in Australia, we probably lagged a lot of markets around the world in growing the footprint of private capital in our economy. And I would probably say, Mark, there's an opportunity to grow even further over the next few years. Interested in your thoughts on this, but I think there's a huge wave of opportunity that sits in front of us.
I think there's no doubt about that. And the more success stories like you were referring to before, say Atlassian, for example, that was once the beneficiary of private capital, the more of those success stories we see, or the growing and immensely successful venture capital space, or the what you might call traditional, although it's hardly traditional, private equity space. As long as the assets and the investments themselves continue to outperform investor expectations, I expect to see significant growth. Our economy is roughly $2 trillion today, and so 68 billion still is only, what is that, 3.4%?
That's right,
of the economy.
Yeah.
And I think in the UK and the USA and some European markets, you'd be looking at 5 or 6 or 7%.
That's right.
So I think there's a lot of room to grow.
There's room for growth, absolutely. So really interested now, you have in your career, of course, spent a lot of time, as you quite rightly acknowledged, in private equity in particular as one of the main sub-strategies under this broad umbrella we're speaking to. Really interested to hear from you, Mark, a little bit more about what the unique characteristics of private equity look like, and to the extent that you can offer some insight as well from your many years of experience around venture and other sub-strategies beneath private capital. What are those unique attributes? What is different about private equity and private capital that sets it apart from other types of investment?
Well, I think the private aspect is clearly one significant aspect. And I've been thinking about how to summarise what is quite a comprehensively big question. Essentially, though, once the funds have been raised, and that's not an easy challenge because obviously the underlying investors want to see characteristics around that fund which match their expectations for the future returns. But once those funds have been raised, in whichever class it is, then obviously you have to find an asset to invest in, which is step 2. Once you've invested in it, to create the value that's inherent within the investment strategy, and then finally, of course, to manage the process of selling it. Now, that can be a 2-year journey if you're really, really quick, or it can be a 15-year journey, depending on the nature of the asset class. In my own space, we were focused on private equity investments into businesses with up to, say, $100 million of enterprise value. And what we discovered was the most crucial elements, beyond any doubt, were the management team that was actually leading the investment. And we were looking for businesses successfully where we could double or triple the underlying profits of that entity. Within that context, the board reporting and the stewardship of the investment was 80% focused on creating value. And I think that does set private capital apart in that it's 80% focused on creating value for the investors.
So you touched on a couple of really interesting points there, which I'd love to hear your perspective on at a slightly deeper level. So you talked about funds, and you talked about raising the capital and then investing that capital into businesses. Talk me through a little bit more about how that works. So when you talk about a fund, what are you talking to here? How does that work? Where does the capital for these funds come from? And then how do you go about identifying the opportunities to deploy that capital or invest that capital into underlying real businesses out there across all sectors of the economy? How does that work?
Well, let's paint a picture of a realistic fund size in private equity. Let's assume it's a $400 million fund. So in order to raise that fund, almost by definition, the team has previously had a successful fund, or they're a spin-out from a much larger player. So nevertheless, they're going to go to the market with their investment documentation, usually referred to as a limited partnership agreement or information memorandum. And whomever they approach, whether it's Australian superannuation funds or other institutional investors here in Australia, or international investors, which is an extremely important element of the Australian fundraising life cycle. It's important that they are able to demonstrate to those investors a very clear strategy about what the investment will be, and that those investors are able to sign up to a partnership agreement that governs all of the investors. Once they've signed up, then their share of any particular underlying deal is governed by the size of their investment in proportion to the scale of the total fund. And that's the difference. So they're commonly referred to as limited partners because they have a limited responsibility for the actual activities of the investment fund.
So essentially what you're seeking from investors is a commitment. You're looking for a financial commitment. You're not necessarily looking for them to write you a check so that you can go and deposit X million dollars into the bank, waiting for investments to come along. You're looking for a contractual commitment which gives you the certainty as the manager of that fund that when you do identify great, outstanding investment opportunities out there in the market, that you can draw upon that commitment, raise the capital in fairly short timeframes, and then be able to execute on the investment. Is that broadly how this process works?
That's exactly how it works. And if we take that hypothetical $400 million fund, a large institutional investor might make a commitment of, say, $30 million. And the first time any capital is actually drawn down from that commitment would be the inception of the fund, but that would be a very small percentage.
Sure.
And each deal in the fund would have a maximum investable percentage of the total fund, usually between 10 and 15%. So deal one might happen in a few months' time. Let's assume it's a $40 million equity check that's required across the whole fund. So each individual investor would be receiving notice for 10% of their individual commitment, and they would make that capital commitment into the manager to allow them to complete the deal. Consequently, over a 3, 4 or 5 year period, their whole commitment is then what we call drawn down. And that 3, 4 or 5 year period is generally referred to as the investment period.
Right. But how do you go about identifying those opportunities?
In private equity alone, there is approximately 2 deals a week completed here in Australia. Now, that does not include venture capital, it doesn't include real estate, and that doesn't include agriculture or infrastructure. So let's say there's 100 deals a year completed in the private equity space. In order to do those, you probably looked collectively as an industry at least 1,000 different companies.
Wow.
And in order to look at those 1,000, the industry as a whole has probably evaluated 5,000. And an awful lot of time is spent trying to find a proprietary deal. I actually don't want to be competing with you for a deal. I want to be buying a company that I've got an exclusive arrangement with. They're hard to find. And any company which is attractive to private equity usually knows they're attractive, and therefore would go through a process of seeking the best private equity partner that they can find.
And this is really where there is a difference between a private capital, very active asset management strategy and a more passive strategy, isn't it? It's fundamental to the differential between those two propositions, is working not just with the business once you invest into it, but actually even identifying those businesses that make good candidates as part of that big funnel that you described. It's about identifying the gems out there right across all sectors of the economy. But that's where this active asset management really starts, isn't it? That's where the hands-on approach really comes in.
We all read about the deal at the end, but what we rarely read about are the months of due diligence that's done before the deal and the different gates and stages within the investment process. Every investment manager will have an investment committee. Those meetings are incredibly serious meetings, and in order to do an investment, to culminate in buying that business, you've probably had 6 or 7 investment committee meetings, and each and every one of those can raise red flags, and always do. And the question is, are there more green flags than red flags?
So this is a discussion where a group of experts from perhaps within the fund, as well as maybe some outside experts, come in as part of this equation as well. But the idea of that committee is to look with a very, very fine-tooth comb at the fundamental proposition around the opportunity to invest into this business. So it's really seeking to minimise risk exposure, Mark. Is that a fair way to look at this?
Absolutely.
Minimising risk and maximising the opportunity and the likelihood of success.
Yeah, there's always risk, and that's one of the challenges that the private capital space has become expert at dealing with. It's actually not trying to avoid risk, but trying to understand risk and how to ameliorate it and how to overcome the obstacles that it presents. Because within risk, of course, there's return, and if there was no risk, then your returns are likely to be fairly mediocre. But the job of the deal team, which is the general colloquialism for the people that are actually looking at the investment, is to work with lawyers, work with accountants, work with environmental consultants, work with strategy consulting firms, work with experts in corporate governance, take a look at the management team and figure out, how good they are, and if they're not good, you're not going to do the deal.
Yeah.
And all of that takes time. It'd be very, very unusual to see any investment done in less than, say, 3 or 4 months, unless it's a very quick public to private transaction,
Right.
Which can be done much quicker.
Yeah.
And those teams, they're working 24/7
Yeah.
for that period.
Yep.
So prior to the investor getting their capital commitment call, all of that work has been done.
Has happened. Yeah.
And it's the responsibility of the senior executives within the firm,
Yeah.
The investment committee members, to say yes or no at the end of the day.
Yeah. You talked a little bit there about scenarios involving taking a public company private, which does happen in Australia, and it certainly happens regularly and frequently in other developed markets around the world. But it alludes to another question that I'd like your take on, Mark, which is different terminology. One of the things that our industry unfortunately is guilty of, and lots of industries are similarly guilty of, really, particularly in financial services, is too much jargon. So let's unpack this for a moment if we can. So we often hear terms like early stage, like expansion capital, growth capital, buyouts, distressed debt. What do those things actually mean? Can you unpack for me really the fundamental attributes of what is different about each of those sub-strategies within private capital?
Well, you've mentioned 4 there, so let's just go through them sequentially. An early stage investment would be a company that might have been going for a year or 2 or 3, perhaps a bit longer, but really does need capital to fulfill their next development of their company strategy. Usually they've been run by founders, and that founder is finding it tricky to work out how to grow the business and retain control and take on board an external investor at that early stage. I think early stage and venture capital are often used synonymously. That's not actually strictly true. A lot of venture capital investments are way before early stage, and early stage usually refers to $5 million, $10 million, $20 million of growth capital. That does move into that whole growth and expansion capital market, which is where we were. And that's all about providing sufficient runway for the management team to implement an acquisition strategy or a market expansion strategy or an international growth strategy. And those are always very time-consuming and challenging and difficult, and need actively involved but patient capital. And private equity is perfectly suited for that. I think the MBO market is clearly understood. This is a very significant part of the activity set within the private capital space. Doesn't necessarily mean huge. There's plenty of management takeovers or leverage buyouts which are not necessarily gigantic, but it's a mature company that requires a change of ownership to achieve its full potential. Now sometimes it goes wrong, and the debt holders are left with debt which is worth a fraction of what it once was. Almost by definition, the existing equity holders in that company would have lost their value. And there are some very good specialist operators who go in and secure the distressed debt, usually converted into equity, and set about turning around that company.
So it's about bringing a layer of stability at the outset and then looking to turn and pivot the business back to hopefully a growth-oriented phase of expansion once again.
There's been some terrific successes in that as well. There's been successes across each of those 4 aspects of the private equity space, obviously. And then when you broaden that question into infrastructure or real estate or agricultural assets, there's plenty of investments made at very early stages of the next infrastructure development.
That's right, and that's often where we'll hear a conversation around markets to do with greenfields opportunities and building from ground zero, effectively. On the venture side of the equation, to add to your reflections on the private equity side of this discussion, you're quite right. I think that the narrative that often is socialised in this context is to equate early stage investment with VC type investment, backing those startup companies that we read a lot about in today's newspapers, which is fantastic. Yeah. It is fantastic to see Australian entrepreneurs bringing their ideas to life through these early stage seed level inception companies and looking to grow and take over the world. I think that's a fantastic aspiration for Australian entrepreneurs to have, and that's really where our venture industry is at its strongest, is backing entrepreneurs, backing their ideas. And quite often it is about backing the people. The idea is in some ways, and it often surprises people to hear this, the idea can sometimes be secondary. It's about picking people who you will be prepared to back come hell or high water in many respects, because you know that they will find a way to bring to market a business that is successful, that will conquer markets either domestically or in the Asia region that we are a part of, or even globally. And here in Australia, I think one of the interesting observations that can be made is the growth of venture here in Australia over the last 5 or 6 years has been phenomenal. It has been staggering, and it's a testament to, I think, two things. One, the opportunity that investors can see in backing these best and brightest, best of breed talent, our management capability and our entrepreneurship as part of that. And it's also about recognising that large institutional investors, as well as family offices and high net wealth individuals, those who might manage self-managed super funds even, a lot of people out there in the context of the investment community can see opportunities to back these investments and to generate some fantastic returns on the coattails of that. Recognising that venture carries a whole different risk equation, doesn't it, Mark, from an investment viewpoint as against, say, private equity?
Oh yes, I mean, in most private equity funds like ours, you'd be looking at a portfolio of perhaps 7 or 8 companies per fund. Now, of course, you're going to get Fund 2 and Fund 3 and Fund 4. I would hazard a guess that if it was a $400 million venture capital fund, they might have 30 or 40 different investments.
That's right. And a whole bunch of those will probably fall over.
Well, that's by definition. That's that's the magic, I think, of VC. Which I've often found fascinating to look at, not being a VC practitioner myself. There must be some real talent in those teams to be able to pick the winners, recognising that they, I can't remember the statistics, but if 2 out of 10 knock the lights out,
that's right.
then we also know that perhaps 2 or 3 out of 10 aren't going to. And I just love reading all of the success stories, and to see the quantum of equity in the venture capital space today compared to, say, 10 years ago. Well, it's just a magnificent story of success.
It is, and I think, again, consistent with some of our opening reflections a few moments ago, plenty of opportunity for the Australian market to grow even further. All that really needs to happen is for there to be ongoing sustainable growth in the pipeline of capital coming in. And every day I talk to fund managers in the venture ecosystem who tell me that there are no challenges, no barriers at the moment anywhere on the horizon in identifying great entrepreneurs that are bringing their best ideas to market. So that's a really positive outlook, I guess, for the venture side of the industry, much the same as it is for private equity. I want to turn a little bit now, Mark, to the timeframes involved in private capital investment, because this is, again, one of the areas that is distinctly different, as we've already observed in other contexts in our discussion. Another very different attribute of private capital investment as against other types of investment out there in the market. Talk to me a little bit about the sort of time horizons we're talking about here, particularly perhaps starting with the conversation that we left a little bit earlier about raising a fund, seeking commitments. What does that journey look like?
In the private equity space, that's almost without exception a 10-year fund life cycle. And within that, the first 5 years are commonly referred to as the investment period.
Right.
So that's when the private equity manager is looking for the underlying investments. It would be very rare for the manager not to have made all the investments within a 3 or 4 year time frame. Each investment itself could be between 2 years and 5 years,
right,
perhaps longer.
Right.
But a very good adage is a good deal is a quick deal. You want to get the company board, get it on its growth trajectory, following the strategy which has been agreed with the executive and the management and leadership team, implement that strategy, and then look for how to realise the value that you've created. Once you get past 5 or 6 years as an investment in PE, then almost by definition, you've got yourself into a place where a lot more work is required to make it a success. Yeah. Our longest investment was 12 years. Wow. And we made very, very good returns on that. Yeah. It was in the construction sector, and we bought it just before the global financial crisis, right. So that explains why we held it for so long. Yeah. But it actually was a very good investment. Yeah. I'm currently chairing a $150 million greenfield almond investment, and that's got a 30-year life right. as a almond plantation, right. But we've got a 10-year investment plan for the equity that's coming in to kick off that $150 million deal. Yeah. Some of the real estate investments, as you well know, they could be 5, 10, 15, 20 years, yeah. And certainly the large-scale port-style infrastructure are almost endless time periods.
So let's talk then a little bit about that day one after you invest into a business. Yeah. You mentioned that in the context of your observations there, Mark, that you invest into the business, you obviously play a lead role in a board context, you work with the management teams. Let's do a quick deep dive just for a couple of moments, if we can, around that. So what does day one look like? How do you, as a private capital investor coming into a business, how do you go about ensuring that the outcome of the work that you do over a number of years, as you pointed out just now, actually helps the business to position itself for another phase of significant growth and expansion? What does that look like at a practical level?
Well, at a practical level, before day one, a lot of work has been put into developing, the 100-day plan. It's a common term, but it is used very commonly. Yeah. And that plan can only be successful if it's truly owned by the leadership team. Yeah. So we commonly refer to them as the C-suite executives. Yes. The chief executive officer, the chief finance officer. In today's world, there's a chief technology officer, yeah. A chief people officer, marketing. A chief marketing yeah. officer, etc. Yeah. Yeah. Now, each of those individuals have got to be fully and totally committed to that plan. Otherwise, it's a pointless exercise. Yeah. And that's the difference. If you go and buy a public company stock, yeah. Even as a significant investor, you're expected to take a pretty backseat role in the direction of the company.
Of course. Yeah.
But as a private investor, you're expected to take a very front seat role. If we draw it into one of our investments, which I was actively involved in, day one would be all about we now have this investment. We were majority investors, so always yeah. more than 50%, yeah. Usually 70 to 80%. Yeah. And we'd be celebrating. That would be the primary thing that happens on day one, because yeah. you're exhausted. Yeah. You've done the deal.
All of that pre-work.
You've got yes. all that pre-work done. Yeah. And it's day two yeah. Where the real work starts.
When the hard work starts.
That's when the hard work starts.
Right. So day two then.
Yeah, exactly.
Let's talk about day two. Let's talk about how you work through at a board level with the management team, with the C-suite that you mentioned. Yep. It is about alignment of interests, isn't it? Ultimately.
Yep. Yeah, very much so.
But how do you bring that alignment? What do you do that helps to ensure that you can actually realise that vision?
So we find in just about every investment that it's a requirement to have a clearly agreed strategy and operational roadmap. That's category one, if you like, of what needs to happen. Then there's the ongoing management and operational development within the company to fulfill that strategy. And that is the job of the leadership team. It's it would be very uncommon not to be having this kind of dialogue,
Yeah.
with the CEO and the CFO
Yeah.
on a daily basis in
Right.
those first 100 days.
Wow.
That would settle over time,
Yeah.
and it'd get into more of a pattern.
Yeah.
But even though on the governance side, every PE firm would have a monthly board meeting, just like a public company,
Yeah.
it would be extraordinarily rare, for the investment director or the investment manager or the management director with responsibility for that investment, not to be talking to the leadership team on at least a weekly basis.
Right.
And it's everything that you can imagine.
Yeah.
It could be a discussion about hedging the US dollar
Yeah.
in a
Yeah.
moment of volatility,
Yeah.
which I was never very good at, by the way. Or it
Most
could,
of us aren't very good
no,
at it, to be
or
fair.
it could be a discussion about
Yeah.
what to do with the requirement for new capital in
Yeah.
a different state,
Yeah.
to build a new warehouse.
Yeah.
Or it could be a discussion about legislative changes
Yeah.
affecting
Yeah, sure.
the backbone of the company.
Sure. So it's really about providing support to the leadership team
Yes.
and in many respects helping to iron out any wrinkles or helping to problem solve. Or in some cases, I imagine, Mark, it might even be as simple as joining dots and making connections with people that perhaps you have in your network that the C-suite leadership team, the CEO, the CFO might not have access to. Sometimes that's the secret sauce that enables the leadership team to be able to overcome any hurdles or barriers and be able to continue on that journey towards growth.
Yeah, and it's we tried very hard to not have this distinction between kind of management and leadership and board and investors. Now clearly there is, and clearly you've got to understand what your job as an investor is rather than as the CEO.
Yeah.
But in all cases, the CEO shares in that value creation upside. In most cases, they've actually written a check, into the
Right.
equity pool,
Yep.
which for the individual CEO is a significant amount of
That's right.
capital.
That's right. Yeah.
And they've done that because we put in place a long-term incentive plan or a management incentive plan, which gives them a good return
Yeah.
on their investment
Yeah.
in the event that the whole investment has a good return.
Yeah.
So you're working very much as a team. And one of the things that does annoy me in the public markets is this distinction between the board and governance and management and the leadership team.
Yeah.
What's that all about?
Yeah.
In my world, that distinction is opaque at best.
Yes.
And preferably not even there.
Yeah, that's right. It is about alignment and it's about pushing in one direction.
Yes.
And having that distinction is important for many reasons, but ultimately when you cut through those layers of governance, when you cut through the barriers and the artificial boundaries that are drawn between each of those roles, it's about growing the business. And,
Yes.
and the role that everyone can play is different, but it is about delivering that growth and expansion over time, which is hugely important. And that's where, as you quite rightly point out, that's where there is a fundamental distinction to be made between private capital, active asset management. That's what we mean by active asset management. It is not a set and forget strategy. It is not buying X number of shares in a publicly listed company and hoping that the management team and the board do the very best they can over the next few years to deliver that growth and expansion and a return. This is very different. This is about being involved in the business, but respecting the role of management, the C-suite leaders, as well as the broader management team to run the business operationally. You're not stepping in and running the business.
No.
You're guiding the direction and making sure that it hits those targets and hits those milestones.
Exactly. And, the best investments are where, the CFO, the CEO, the chief people officer, the chief marketing officer, etc., that team,
Yeah.
are not, looking for guidance and help,
Yeah.
but do want to talk about the future and the strategy and, developing the way
Yeah.
through the plan in a positive way.
Yeah. So let's turn now to something we touched on a little bit earlier, but again, let's explore at a slightly deeper level the types of businesses that make good candidates for private capital investment. This is probably an open-ended question, really, Mark, because there is no set criteria, is there? There is no formula that dictates that one business is a exceptionally good opportunity and another business is not. There is a degree of opaqueness, of course, but fundamentally, if you were looking to segment the economy and segment the sectors within the economy, what What's a general profile for the types of businesses that would be more likely to make for good candidates in private capital investment?
I think the first step to answer that question is to identify the strategic allocation that the fund is looking for into those different asset classes.
Yeah.
And it varies enormously. But if we're talking about private equity, then the investment team are looking for companies that have got a proven track record of profitability.
Right.
They're looking for a minimum scale, which is appropriate to their fund size.
Mm-hmm.
They're looking for a clear market position of leadership,
Mm-hmm.
and if not leadership, then a strong position where perhaps leadership can be achieved.
Right.
You'd want to buy number one or number two or number three in its particular market space.
Right.
Crucially, and where an awful lot of time and effort is spent, they're also looking for a company which, once they have doubled or tripled the profit, is an attractive company for somebody else to buy.
Right.
And that can be through an IPO, or it can be through a trade sale, or it can be to another larger fund, which we call a secondary.
Right.
So if you've got all of those aspects, a proven track record of profitability, a good management team, a number 1, 2 or 3 position in the market, and a very good strategic plan going forward with a view to who you can eventually sell it to, then you're in business.
Yeah.
Then you've got a company to really start looking at.
Yeah.
Depending on the scale of the fund, those metrics will be different.
Yeah.
For us, where our last fund was $250 million of equity,
Mm-hmm.
we were looking for companies with a minimum $5 or $6 million of EBITDA profit,
Right.
up to a maximum of, let's say, 20. And if you run the numbers on that, that would allow us to make equity investments in each investment of between $25 and $30 million.
Right.
Clearly, if you're sitting on $1 billion fund,
Yeah.
then you'd be looking for companies that are making $50 or
Yeah.
even $100 million of EBITDA.
And are there sectors of the economy, Mark, that are out of bounds in this context? Are there sectors that are just too difficult to make an investment proposition work in?
I don't think there are any sectors where it's out of bounds if you look holistically across the whole landscape. But for any particular fund, they will have defined which sectors they want to invest in.
Right. Okay.
So each fund
Yeah.
will have a set of parameters which
Yeah.
their people who have signed that partnership agreement would not expect them to step away from.
Right.
And that's crucial.
Yeah.
There are clearly some sectors which are much more highly valued and regarded and attractive than others.
Sure.
And that comes down to price and availability.
Yeah.
And in today, right now, anything to do with healthcare and technology
Yeah.
have got some huge valuations
Yeah.
attached to them. There are other sectors of the economy that you couldn't give away.
Yeah. Yeah. Yeah, understand, and I think that certainly holds true in a private equity context, and it absolutely holds true in a venture context as well.
Yeah.
There are some sectors for venture investors out there in the market where there tends to be almost a gravitational-like pull. And I think ICT, digital-enabled businesses, of which you can probably say most businesses are today, but those businesses that are at their core tech businesses have in Australia over the last decade attracted huge amounts of capital investment through venture, as they have through private equity in many respects as well. And then you've got probably the other sizable area where investment has been most active over the past decade, and probably even longer perhaps in a venture context, is the life sciences area.
Yeah.
Of which healthcare, primary healthcare is a component. You've got research discoveries, therapeutics, medical devices. All of those areas have tended to be A, successful, and B, present very compelling opportunities for venture investors here in the Australian market, which ties in very neatly, doesn't it, with the point you make about healthcare in a private equity context. So it's almost as if you sort of get this continuum. You get venture funds investing in these very, very early stage businesses, seed capital and then growth capital later on through venture. And then as these businesses mature, they continue to deliver success in the market, regionally and in some cases globally. they might then find themselves ideal candidates for a private equity investor.
Yes, and it's beauty is in the eye of the beholder, and lots of funds have got their areas of specialisation, and the three that you've just mentioned there, of course, fintech or ICT or healthcare, are highly sought after. But that's not to say that you can't make a very good investment return in other sectors.
Absolutely.
It's just a different skill set and a different approach.
Yeah. So, Mark, we're getting towards the end of our discussion now, and I want to close it out by just speaking a little bit to some of the key considerations for any investor.
Yeah.
Whether you are a sophisticated institutional investor like a superannuation fund, as you mentioned earlier, whether you're a family office, whether you run your own self-managed super fund, what are the types of considerations that should be uppermost in your thinking when you're considering investing into an asset class or a strategy like private capital?
Well, there are, I think, three fundamental aspects. It's got to be a reputable private capital group, and that relies on a track record. Right. Whether it's the same group or they've come from a different group, it doesn't really matter. But there have to be people who will pass the due diligence test that you as the investor are going to apply to that particular private capital opportunity. And that's a very big question. And a lot of time and effort and money is spent by the larger institutional investors and some great research companies like Cambridge Associates, for example, to demonstrate that track record of success that you're looking for. And there's no question about it. A successful track record leads to a successful future. And that's clearly been demonstrated over the years. Having said that, it's quite important that we allow for new funds. Otherwise we'll be stuck, and we won't be growing and we won't be developing. So there is the opportunity to invest into private capital deals with new funds, and that all comes down to the investor's confidence in the ability for that fund to get out there and find attractive investment opportunities.
And often, Mark, that will come down to the investment leadership of that fund. What experience they have individually. The sign, I say this all the time, but the sign, the logo on the door might differ. But if the people who are at work doing the heavy lifting on identifying and uncovering those great investment opportunities that you spoke to earlier, have their own personal track records, perhaps wearing a different set of stripes, as it were, with another fund, that's what you're really looking for, is the expertise of those who ultimately will be the people making decisions and making very important decisions day to day about the types of investments, the scale of the investments, and how to manage those investments over those many years of the horizon of the fund.
Yeah, exactly. And it doesn't matter if it's your own self-managed super fund or you're going through a large-scale industry super fund or a fund of funds. It's crucial that, as the individual investor, you have confidence in that leadership team. The third leg, of course, are demonstrated returns. Yeah. So why would I invest in private capital unless I felt that I was going to get a better return than not investing? Yeah. And that's an allocation decision. It's a percentage of my investments are in private capital. I think any Australian who's got their interest in superannuation, by definition, is invested in private capital. They are. To a greater or lesser extent. Yeah. And it continues because the returns are demonstrably providing alpha, which we use as one of those jargon that you asked me not to use. Yes. But alpha is simply the opportunity to gain better returns than average market would suggest you could expect.
For today, thank you so much for your time. Thank you for your insights. Your many decades now of experience in this industry has certainly allowed you to see a plethora of different insight across what's worked well, what the learnings are from other scenarios that haven't perhaps played out as best as possible. But all of that is part of the fabric of private capital, and that's what, again, makes this industry is so uniquely different to many other strategies within financial services and within investment programs broadly. And I'm really passionate about this. I know you are as well. There is a tremendous opportunity ahead of us here in Australia to grow this pipeline of capital to support great Australian businesses, and that's the remarkable thing about this industry. It is very tangible. You can go out and touch and feel and buy the products and services from the businesses that are backed by private capital. Thank you so much for your time.
Every day, and I appreciate that. Yasser, thanks very much indeed for giving me the opportunity of talking to you. It's been fun.
Thanks, Mark.